Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, July 23rd. Warehouse Club retailer Costco said Wednesday that its fourth quarter earnings per share are currently expected to be well below the current first call consensus estimate of $1. Trying to provide some perspective for analysts, Costco said well below meant more than the 5-cent per share it implied on a May 29th conference call. The warning was attributed to three primary factors. 1, a significantly greater than anticipated LIFO charge. 2, an anticipated negative swing in year-over-year profitability in its gasoline operations. And 3, slightly lower than planned merchandise profits related to holding selling price points to help drive sales and maintain the confidence of its members. Management did what it could on the conference call to temper the market's negative take on the warning, emphasizing that it is due largely to the LIFO book charges it will take in the quarter. The LIFO is an accounting method that stands for last in, first out. Under a LIFO method, the goods the company acquires most recently are used as the basis for computing the cost of goods sold. The FIFO method, which stands for first in, first out, is the typical accounting method used, but companies will establish a LIFO reserve when there is a difference between the two. Costco indicated that it experienced a slightly deflationary trend in prior years that were offset by a LIFO credit balance. However, with vendors charging Costco more in response to their rising input costs, that circumstance has changed and has led to the greater than anticipated LIFO charge. Costco clarified that it will likely have LIFO charges in the next couple or several quarters. That admission is not helping the stock since it's altering the market's earnings assumption for this retailer, which had been trading at 24 times estimated earnings ahead of the warning. The retailer said it will do what it can to delay passing on the price increases to consumers. It did acknowledge, however, that the price increases it encounters will ultimately have to be passed on. On a brighter note, the company reported core merchandise margins, excluding gasoline and LIFO, were still up for the first weeks and that it has seen no meaningful changes in sales patterns since its June update. That hasn't been enough of a consolation to the market, which has driven Costco stock 12% lower in Wednesday's trading. For the most part, Costco continues to execute in an enviable manner, yet investors have been put on notice that earnings are not likely to be all they can be. Entering Wednesday's trade, shares of Costco were up 3.2% for the year versus a 13.1% decline for the S&P 500. Now, Costco is still outperforming the market, but its performance gap has narrowed considerably as the warning and the tough comparisons that lie ahead for the company are providing good reason to second-guess the stock's premium valuation. I'm Pat O'Hare for Briefing.com. Thanks for listening.